Well, good morning. I'm delighted to be here to chair today the session we have on crypto and digital assets, Hubris, Nemesis, and Catharsis. And those of you who are schooled in Greek tragedy will already be looking forward to the story as it unfolds. So you'll know me, I'm Mike Wardle. I'm the CEO at ZN. I'll be chairing today's session. My job really is to do a few housekeeping things and then give the floor to our guest, Professor Alistair Milne. Just briefly to say a thank you to our sponsors. We're very fortunate at the FS Club to have a range of sponsors who allow us to run these sessions and to bring guests to share their insights and expertise with you. Just a word on today's programme. Very simply, my job is to do the housekeeping and get out of the way. We'll have about a 20-minute presentation from Alistair, and then Q&A session. For those of you who haven't used the GoToWebinar system before, the way to put a question to the system is to find the question tab on your dashboard on the screen, type in the question, that will come to us, and I will field those during the Q&A session. The session today is being recorded, so you have an opportunity if you want to go back and revisit any of it, or you want to share it with your friends, there'll be that opportunity, and the recording will probably be up within about 48 hours on the event page. That's all by way of introduction, and so really to pass on to introduce Alistair Milne, Professor of Financial Economics at Loughborough University, and someone who's done a lot of thinking in the whole space of digital assets, crypto. Alistair, the floor is yours. We're delighted to have you with us.
Thank you, Mike. And I'm beginning to lose count. I think this is possibly the third of these webinars I've done over the years with the FS Club. No, it's a pleasure to be here again. For those who haven't come across me or my work before, I'm university-based. So, my main jobs are teaching and writing erudite papers. But I've focused a lot of my time and attention on transaction banking. So there's not both capital markets, retail payments, for more than 20 years. So with all the growing interest in fintech and in particular in crypto, I think I've felt I've been in a good position to put in some, should we say, more independent views, not necessarily driven by the latest fad, and that's inspired the title, which I'll say a little bit more about in a moment. There's a whole lot of supporting research, so if you if you're suffering from insomnia and you want to get into the details, I try to make this stuff readable. I particularly, there's a current paper which is not yet published, which I'll certainly be seeking to put into the public domain in the next couple of months, which is focusing on much the same issues as I'm talking about today. And there's other related work. The paper in the Journal of Money, Credit and Banking, for example, is looking closely at some of the terminological issues in this world.
Sorry, Alistair. Sorry, yep. Sorry to interrupt. We can't see your slides yet.
Yes, so we lost the sharing. I'm a bit surprised that Look Show Screen. I've got screen monitor 1. Is that, you should be seeing supporting papers?
Yes, we are now. Thank you.
Okay. Not quite sure why that got lost, but there we are. Yeah, so pause for that. So this is me, and I'm just describing some of the background work. I thought we'd start with an audience poll. I think might be in a position to help this, because I get a view of this is a topical issue. HM Treasury reflecting Andrew Griffiths as the lead minister has been taking a view that there's an opportunity for London and UK financial markets to be globally leading as a respectable jurisdiction for trading and activity in crypto. But actually only today there's been released a Treasury Committee report which take rather the opposite view and say that crypto should be viewed as gambling, and they're critical of the notion that crypto should be given the respectability of being a regulated financial asset. So that kind of nicely highlights a basic question: is crypto a competitive opportunity for London and UK financial services? So say Andrew Griffiths would argue strongly, yes, it is. Members of the Treasury Committee, including from his own party, seem to have more reservations. Okay, so I think I can see the poll results. I'm not quite sure how I see them on screen.
I can help there, Alice. I've got them here. So it's yes, 48%, no, 52%.
Okay, a very even split, very close to the kind of a Brexit-style balance of opinion. I'm on the no side. I'm on the skeptical side, and let me go through. The rest of this 20 minutes will be about trying to, in outline, say why I tend to agree more with the Treasury Committee. I'm not necessarily arguing it should be regulated as crypto, as gambling, but I'm not sure crypto is such a substantial opportunity for UK financial services. A quick word on my title. Yes, this comes from Greek tragedy. So in Greek tragedy, catharsis is experienced by the play's characters and the audience, and this could be a play such as Oedipus Rex. So the hubris, the pride or misunderstanding, which then leads to the tragic consequences, the nemesis. But then from all of this, we can draw a cleansing and a deeper and better understanding. And I'm hoping that, well, I think that's what we all need, is a better understanding of crypto, what it really is, rather than what the hype says it is. I'm also noticed a little bit from the regulatory point of view of a parallel with the early 2000s. I won't dwell on this too much, but I recall only too well the enthusiasm about credit risk management and substantial lobbying that inspired Basel II, and that in effect masked growing risks in 2003, 2007. I don't see crypto yet as a major systemic risk, but it could grow to become that. And so it's important to be clear-eyed about what's actually involved in crypto and digital assets. So I'll summarize the takeaways. I won't have time to go into all the detail of the underlying paper, but I think what I'm hoping you'll be able to take from this talk is first some of this awareness that we often use words very loosely, and I'm going to highlight what's known as the distinction between permissionless and permissioned holding of digital assets. So in my view, it's the permissionless holding. I'll explain that in a moment. And then the central question for regulation is, how do we treat permissioned assets are actually not such a problem. How do we treat permissionless assets? And many of the questions that regulation is focusing on at the moment, such as, is this a security, are actually a bit of a side issue. And finally, I think promoting crypto as a new asset class is, I think, a little bit confused. Yes, the digital technologies give us new ways of holding assets. So we could hold securities or bonds and other investment classes through digital technologies. Cryptocurrencies are new, but they're very narrow. The idea that this is going to be a huge new asset class seems to me a bit of it's far from clear that's what's going to happen going forward. Okay, so I've already used up a good part of my 20 minutes. I think I've only got about 12 minutes left, but I'm going to intend to look at a historical review. That'll be brief, but I think it highlights some useful points. I'll spend most of my time on this permissionless, permissioned, and then I'll briefly touch on some of the policy issues at the end. And then there'll be the opportunity, as Mike has said, for questions and discussion. So this is the historical review. You can trace this right back to the dawn of the internet, which actually goes back to the 1960s. And technology developments can appear suddenly, but they're long in gestation. And I think the particular thing I'd often highlight here is the key role of public key encryption. So the so-called RSA algorithm was the first breakthrough in that, based on prime number factorization. But there's others. Elliptic curve cryptography is nowadays the norm. And the key point there is that it makes a cipher, hiding a message, encrypting a message, essentially immune, unbreakable. And that's true even if you're considering the possibility of quantum computing, because it's kind of an arms race. You can always strengthen the encryption to deal with a quantum that may not be easy to retrofit into our systems. I particularly like some of the early developments. David Chaum, those who follow this area closely will be aware of his work on DigiCache, again 40 years ago. Then there were many developments in the internet. But there was a lot more before the 2008 Nakamoto white paper, which ushered in Bitcoin and started all the interesting cryptocurrencies. Then it was only around 2013, so I did a quick chart from Google Trends. We began to get this more widespread mainstream interest in crypto. So one other thing to pick out from the historical review, and I think this is still important today, how much the early interest, this is what motivated Nakamoto or whoever he or whoever they are, because it could be he, she, or they, we don't know who's quite behind the Bitcoin coding, was the so-called cypherpunk movement. And here are the three leaders from a Wired magazine cover of 1993. The whole motive behind Chaum's DigiCache, behind the Bitcoin, development of Bitcoin, was to create forms of value and exchange on the internet which would have some of the properties of cash, in particular privacy. So the whole movement, the CryptoPunk movement, was to protect individuals and their privacy from encroachment by either private companies or government. Quite a libertarian or hippie perspective. I'm not quite sure. It's John Gilmer's on the right. I'm not sure. Photographed a bit more recently, 2018. I'm not sure who he is in the Wired photograph. Okay, so let's get on to the key with that background in mind and this emphasis on this libertarian philosophy. I'm going to show you. I'm going to jump into a bit of detail, but then try and step back from the detail. So the detail is this rather. I've made an attempt in a table in the supporting paper to classify all the key crypto asset developments, digital asset developments, with a focus on financial assets. So I haven't included NFTs or non-fungible tokens that some of you have heard of, and I should squeeze in ICOs, but I haven't quite worked out how to do that. The important message here is not the detail, though there is lots going on. I think perhaps the message is it's easy to get confused by the detail. And the key point I'd make is to distinguish the top panel. So you'll see there's 3 rows in a top panel, which are the permissionless crypto or digital assets. So they include cryptocurrencies, stable coins, and also all the most recent developments are what might be called programmable blockchain. So some of you may have heard of decentralized finance or DeFi, Uniswap being the most important exchange, but unlike Binance or the failed FTX, Uniswap is purely code-based, which I think gives its users and purely transparent. So it gives its users of Uniswap a lot more confidence, I think, in exactly what their risk exposures are. So that's kind of interesting. But the key thing I'm emphasizing, in highlighted in red, is that all of that is permissionless. It's open source. Anybody can go in and use it. Then we can distinguish that from a variety of permissioned digital assets, which use some related technologies, especially so-called distributed ledger technologies. But as I'll discuss in a moment, the fact that they're permissioned. You need to go through an institution in order to get access to them. So that would include wholesale initiatives like Finality or RTGS Global, various forms of e-money, various forms of retail distributed ledger money. So DM, well, that project's failed, but USDC coin, which essentially are in both spaces. They're in the permissionless space and potentially in the permission space as well as a regulated form of money. And of course, CBDC. And I think it's clear that any CBDC project is going to be a permission system. We're going to know the identities of those involved. And then finally, there's some broader applications of the underlying technology. So we might put things like trade finance or syndicated loans, commercial or residential property, and other assets which are relatively liquid might be put on distributed ledger and potentially more easy to trade and price. And a broader general desire, which I think financial market participants have been discussing for 20, 30 years, but how can we automate and take all the costs out of our operational systems? But the key point again, the permissionless is very different from all the potentially valuable permissioned activities. Okay, so I've only got about 5 minutes left, so I'm going to make sure I need to take the next bit a little bit slowly and get what I think is the key point across. The key distinction between permissionless and permissioned. Now, I particularly draw attention to, I think, is an excellent report by the Law Commission dealing with for England and Wales, which was dealing with a central problem for our legal colleagues, which is how do you define property rights in permissionless digital assets. And so they proposed what they call a digital object, with the key criteria being that it's something which exists independently of persons or of the legal system. And that's the key feature, the one I think we should all have at the top of our minds about cryptocurrencies and indeed stable coins. Whatever happens in terms of institutional failures, those permissionless claims are still out there. They can still be transacted. Their value may be uncertain. Even a stable coin may fall substantially in value below its par. It could, like Terra Luna, fall to zero, but that doesn't stop you transacting in it and moving it around using these permissionless systems. Open source digital records and what's known as a decentralized consensus mechanism. So that's the famous proof of work in Bitcoin. We now have proof of stake, which is much more energy efficient in blockchain. But clear divide, permissionless crypto versus permissioned mainstream. Now, the academic, I'm seeking to get a peer-reviewed publication, and at the center of that is this proposition. And the key of that proposition, and everything else in the paper in this talk follows from this. If you've got a permissioned digital ledger, DLT, although you're creating a construct which is similar to that used in cryptocurrencies, ultimately you have gatekeepers. You have legal entities, financial firms or other firms that are responsible for validating the records, just like my bank is responsible for validating my or your bank account records. And as a result, all the conventional law and regulation still applies. Once you go permissioned, you're simply dealing with a somewhat more collective, cooperative delivery of conventional financial products, hopefully more efficient, avoiding some of the complexities and dealing in a more open and transparent way with things like counterparty risk, but not fundamentally different from what's gone before. Whereas permissionless is fundamentally different. And I'll just briefly comment, and I know I'm very much pressing up against my time now. I think this is sort of a couple of more further terminology. The permissionless to me is central, but I think that then relates to certain other, should we say, terminological ambiguities. So there's a lot of talk about smart contracts, but again, smart contracts are only really new in a permissionless context where everything is in the code. If your system is, if your record system, keeping system, your ledger where digital assets are held is permissioned, then ultimately you're still talking about simply automation and the possibility of unwinding a contract by getting the controlling entities to agree, the possibility of taking them to court and saying, no, this is not what was legally agreed. So the smart contracts are no longer irrevocable. They're only deliver complete finality in the context of permissionless transactions. So we're confusing pre-coded contracts for exchange of permissionless digital objects with automated execution of contracts for all other forms of property. And another term which I think is very confusing is tokenization. The whole paper I referred to in the earlier slide is saying this is a false analogy, and it actually doesn't make much. What makes sense is to talk about an asset which is directly held, so not the liability that's held indirectly through a custodian bank, for example, but the word tokenization can introduce a lot of confusion. Okay, so this is where I'm going to finish essentially with a brief word on public policy issues. I think my final main comment is that what we're really talking about is a new world of broader data access. That's what cryptography, so to go back to the historical timeline, the emergence of public key cryptography and its increasingly wider application. What cryptography supports is very finely controlled access. It's a big issue in not just in financial services, it's a big issue in public health, for example, deciding who has access to individual records, and we have to manage privacy concerns. And I think this is not a one-time revolution, it's a trend. I think there's, and this is a topic for many FS Club seminars, there are huge opportunities for operational improvement in financial services based on cryptographically secured data access. But crypto assets are actually almost the permissionless crypto assets are not really relevant to that. On the policy issues, I'm not going to attempt to go through talk in any detail in any of the slides. There was a legal issue about property law, which I mentioned before. But the key, I think the leading regulatory response are the EU MiCA regulations, which I think are sensible. Because you can't regulate permissionless assets directly. What you can do is regulate firms, legal entities, or individuals who provide access to or promote transactions in crypto assets. But I think the key thing, which I think is missing in, for example, current HM Treasury-led discussion of crypto regulation, not more clearly separating permissionless and permissioned. And the open question is, well, to what extent do we allow financial institutions to transact in permissionless assets, and in particular support transactions for unsophisticated retail investors? I'll skip. There's the paper itself, which I'll happy to take questions or follow up afterwards. A few more comments about stable coins and about a nascent asset class. I think the main point on crypto digital as a nascent asset class is that there's no underlying cash flows. Neither cryptocurrencies nor stable coins offer you an income. They may be valuable from liquidity purposes, but they're not really that different from fiat currencies from a liquidity end user point of view. You may, if you're a crypto funk, a libertarian, think it's useful to have some cryptocurrencies that do not depend on the state as an alternative to gold, as a source of value in the event of the collapse of capitalism and the end of civilization as we know it. I think I'd trust gold more in that context, because the internet itself might fail in such extreme circumstances. But there is an argument for holding some crypto as an asset to protect you against a doomsday scenario, or just because you don't want to have anybody snooping into your life. But otherwise, I think it's minor. There's different forms of tokenized assets. I'll skip that. Regulation of DeFi, again, that can be done in a very similar way to crypto. So a rather rushed end, because I wanted to emphasize again the key issue is permissionless, permissioned, and crypto, properly regarded as permissionless, is from my point of view must remain relatively minor. We can use all the potential technological advantages which have emerged in the context of crypto, but we can use them in a permissioned way, which means essentially using the same regulations and same arrangements as we have for conventional financial assets. We're going to do the poll one more time, and then there should still be at least 10 minutes for question and answer. Oh yes, I was going to comment that the catharsis in my mind is the realization that there's much less new in crypto than many of the hyped proponents would suggest. Yes, there's a hugely valuable technology, but it's really not as fundamentally new as some claim. Should we repeat the audience poll? As I say, I can repeat my conclusions while people are thinking about their response. We'll see if the needle has moved at all. But my fundamental point is that yes, crypto is new, but it's new in this rather narrow area of permissionless assets. And my judgment is that neither regulators nor market participants ultimately will want to have any substantial part of our portfolios in a permissionless form. We'll end up sticking with permissioned, and that's not really very different from what we have already, except potentially from a technological point of view, it's a lot more efficient.
So we have the results in, and okay. It's shifted enormously slightly. And there's now yes 47, no 53. So we're almost exactly where we were at the beginning.
Okay, people need to reflect. I'm hoping I developed a strong knockout blow, but clearly there are many rounds of this this debate, or prize fight if it is, still to be had. Okay, we've got time for questions and answers. I think we still have around 10 minutes, so let's see what comes in.
Well, thank you very much, Alistair, for that run across some of your thoughts on where we are with crypto.
A bit of a sprint, but I'm happy to elaborate on anything which didn't come across too clearly.
Super. David Birch said, he rather likes the gambling idea, and of course, refers obviously to the Treasury report on how we should regulate crypto. Yeah. Which has opened up the consultation question. So, I mean, I guess if you were to apply the gambling analogy, how would you regulate crypto from that perspective? Is it looking at the institutions as in the EU meter?
So I'd certainly like to see all those warnings for retail investors that we saw, I mean, we get an immense amount of gambling advertising on TV screens, but at least it does come with those warnings about the importance of not getting sucked in to the gambling and potential addictions. Look, I think it's still an open question. I think the way I would phrase it from a practical point, I think this is where I'm more supportive of the HMT reviews. They don't actually say that they're trying to create a framework for regulation, and they want the FCA to be given that responsibility for it. The FCA could, in fact, in turn, take the decision, well, this would be rules, not in the fundamental regulation. This is actually very akin to a gambling product. So the FCA could then take the decision to bring in very strong retail protections, which would include warnings similar to those we see for gambling on whenever any institution is involved in potentially supporting retail investment in crypto. So I usually find I'm of a similar point of view to Dave and always value his opinion. So I don't think we're actually very far apart on this. And it's simply and I'm not sure practically if you could put all the crypto over to the Gambling Commission, because there will be more sophisticated investors who are using some of the permissionless crypto, experimenting with it in a more so I think in practical terms, even though I agree with the spirit of it being viewed as gambling, I'm not sure ultimately that will be the best decision.
David sort of follows up by saying his understanding is that many people who've invested in crypto or hold crypto have lost money. Just musing whether there's a lawsuit for mis-selling around the corner.
Yes, it's kind of, I mean, and maybe even more so in the US, where there's been, which of course always jump quickly to their lawyers, and there's been huge problems with, particularly, I mean, there's a big racial bias. So it's been Afro-Americans in particular are overrepresented amongst those who've lost substantially on crypto. A temporary reprieve because crypto's bounced back a bit, but I absolutely do not underestimate the need for retail protection. So if the FCA gets this responsibilities, they're going to have to put that front and center.
Thank you very much. Masinisa Amaziani has asked how it is that central bank digital currencies may help to promote financial inclusion. I just wondered whether you have any thoughts on that.
Yeah, so that's a good question. I mean, more broadly, it's a good question about, okay, maybe these private crypto assets don't really have the legs that some people claim, but central bank digital currency could be a big game changer. I'm not so sure it's a game changer for financial inclusion, in the sense that we could promote e-monies for that purpose, and they've been quite successful in some emerging markets, most notably East Africa and China, but some others as well. Ghana has had a lot of success in addressing financial inclusion recently. And yes, there are a number of countries worldwide, Nigeria notably, promoting CBDC but it's not the CBDC itself that's critical. It's the ability of a easy to use mobile e-money, whether that's technically a CBDC or a privately developed, possibly fully reserved e-money, I think is less important. The only other thing I'd say on CBDC, I think there are potentials for two related comments. I think there are valuable opportunities in wholesale finance for use of CBDC as a settlement asset. But I'd say these are all going to be permissioned. Maybe that's the other comment I should make in terms of that, whether you're using a CBDC in Nigeria to address financial inclusion, or we're trying to use a CBDC here in London to improve financial market performance, liquidity, and access. It's going to be a permission variety, not permissionless. So it's actually not that different from what we do already.
Okay. Yeah, the issue, I guess, from James Olive here is: do you think there's a difference in the custody of permissioned as against permissionless distributed ledger systems?
That's a great question, and it really focuses on this notion of tokens, which I said, be careful with that word, because it's often used in rather confused fashion. So I think one possibility, which and there are arguments that we should be going in this direction, is that instead of holding our securities in custodian banks, we should actually be holding them directly with the CSD on the Central Securities Depository. But actually, investors would still need custodians in order to manage all the tax and corporate governance elements of portfolio management. They'd still need them for tracking their portfolios. So I think it wouldn't be such a fundamental shift for the user's point of view. What it could do is it could help promote greater transparency, making it easier for corporates to know who their shareholders are and communicate directly with them. It does raise some questions about security of borrowing and liquidity. So, and I think it also raises questions about when we hypothecate or rehypothecate assets in order to support market liquidity. So I don't have very clear answers. I think it's a great question. I think it's one of the areas we should be doing a lot more research on. And my bottom line again, it's all going to be permissioned. So it's not really going to be crypto in my view at all.
George Bynor has jumped in to ask, how do you feel about NFTs as an opportunity to represent evidence of ownership of assets?
That's interesting, and there is another big policy agenda is to do with the use of digital technology in global trade. So there's a big policy effort to replace bills of lading as paper documents and letters of credit with their digital equivalents. I think the interesting thing then comes from again, I think it's more of a practical question. It'll still be permission for sure. Will it be helpful from a technology point of view to have a decentralized ledger, a single record, or do we want some other form of verification to prove that it really is the asset really belongs to it belongs to? So whether that's a centralized database, which would be the conventional way of doing it. I mean, I don't have problems with my credit card getting it accepted, and where necessary, they could, when the transaction is online, they can check that the credit card is not stolen. There may be other circumstances where we're having a decentralized DLT, NFT type representation may actually be advantageous, but it's a practical question rather than being one of principle.
Thank you very much. Hugo Innes has commented that the challenge of crypto has been that it's tried to recreate the banking system, but quite badly, in fractional banking, etc., and became a sort of hype, and the only way is up. But he just would wonder whether the good thing that crypto has done is focusing the need to reduce friction costs in banking.
Yeah, I mean, I'm very sympathetic to that. I think there's been a huge discussion about DLT, and that's, I would go back to my title. It's the hubris was the thinking that something is a new form of database called a blockchain or distributed ledger would somehow of itself solve all the frictions in banking. I mean, one of the things we've seen over the past couple of years is a huge amount of disappointment in the DLT space. Very many of the most touted projects, most notably the ASX project at the Australian Stock Exchange, have been halted, and said, no, that's not the way to go. So we've had an oversimplified view about how sharing of data and data access can improve efficiency. So I think that's the Nemesis. DLT has hit its nemesis, but I think the catharsis is the realization. Yes, data access and data sharing can support huge efficiency gains, but we can't hide away from the governance issues, the concerns about commercial confidentiality, and indeed the need to maintain these systems as well as just create them. So I think we're going to come to a new, more realistic era where we will gain the benefits.
Thank you very much. Richard Metcalf just said, would you mind repeating or going over again sort of the rationale for not treating some of these assets as gambling?
I'm saying it's an open, practical question, so I don't have a strong opinion. My immediate reservation is that, well, firstly, we can't stop people using them because they're permissionless. And I think inevitably they're going to be more wholesale, sophisticated investor involvement in crypto and crypto-related assets, and so to try and draw a sharp line and say these are not financial assets. Even sophisticated investors need some form of regulatory protection, and so I think just treating them purely as giving the responsibility to the Gambling Commission, I think probably is not the way to go. But if the FCA does regulate and says, no, we're going to view them as gambling assets, I think that could be quite a sensible outcome.
Thank you very much. Just a couple of comments to put in before we go to the final question. First of all, George Ryan just said yes. Well, your question is, who would you sue for mis-selling?
Yeah.
And David Birch just commented that the sort of cypherpunk movement maybe wasn't as hippie as you think. Timothy May, after he left the cyberpunk sort of leadership, certainly was known for quite a few racist views and quite problematic views. So libertarian maybe, but maybe not hippie.
There may be a few racist hippies. I don't. It's not quite my era.
Indeed. Just the final issue is Philip Middleton's just asked you to comment on the balance between the need for enhanced proofs of digital identity on the one hand versus the desire for anonymity on the other.
That's a big question, which we probably need another seminar. I'm not webinar. I'm not sure I'm the best ideal person. Look, it's a very tricky trade-off, and I think I'll give some personal reflection. It's quite cultural. So I have spent a lot of time working in Nordic countries, particularly Finland, where I've done extensive work. And the Finns have this very open view. If you're in Finland, if you want to know about your neighbor's tax returns, you can look them up online. Everything's open, and they have pretty good digital identities. So their choice is at one end of the spectrum. We don't care so much about privacy. It's actually a bit boring to look up Mikko Häkkinen's tax returns. You just learn he's quite wealthy. Whereas here in the UK, and I think even more in the US, we're much more concerned about those privacy concerns. So it's a tricky balance, and I think it's something that's quite obviously cultural and political, and it has to be a different balance in every jurisdiction.
Well, thank you very much. We have really reached the end of time. Final comment from David Birch, suggesting that the people to sue are people like Paris Hilton and the other celebrities who are pushing cryptocurrency through their influencer channels. I don't personally follow Paris Hilton on social media, so I can't vouch for that. So as we come to a close, some thank yous. First of all, again, to our sponsors for enabling these series of webinars. It's a real privilege to have such support. So thank you to them. And then just to mention the forthcoming events, do keep an eye on our website for what's coming in the future. But we have quite a lot going on. So tomorrow, Constructing the Future, ESG and supply chains in construction. Friday, talking about threats to resilience. An in-person event on Tuesday in London, catalyzing the Green Development Pact through financial architecture reform, quite a major issue, and looking forward to the Net Zero Summit on Wednesday, and then parametric insurance in 2023 on Wednesday next week. So an awful lot going on. Do keep an eye on the websites and do join us for any of those. Finally, just to offer my thanks to you, to the audience, for turning up and engaging with us so well in the Q&A session, but mostly Alistair, thank you so much for your presentation and the stimulating thoughts that it created. Normally on a presentation I'd throw open the floor for a big round of applause, but we can't do that today, but I'm sure the audience would want to join me in thanking you very much for your time and your contribution this morning.
Thank you, it's been a pleasure.
Thank you very much. We'll see you soon. Thank you.